Welcome to the Deep Dive. We unpack complex topics, turn them into actionable insights. Today, we're diving into something really important for freelancers, for small business owners in the U.S. It's the home office deduction.
That's right, a powerful tax benefit, but yeah, often misunderstood.
Now, I understand something big happened after the 2017 Tax Cuts and Jobs Act. It sort of changed the game for this deduction.
It really did. You see, before 2017, W-2 employees could sometimes get in on this, but that's gone now, suspended. So yes, it's become this exclusive advantage, really a structural benefit just for the self-employed, not just a line item anymore.
Interesting. So it's more valuable because it's exclusive now.
Exactly. And our mission today really is to give you the clarity you need, how to claim this deduction confidently, correctly. We'll look at the pretty stringent IRS rules, compare the two main ways to calculate it, and importantly talk long-term strategy.
Okay, so first things first, before we even touch a calculator, what are the absolute must-haves, so those big hurdles the IRS puts up? What are they really looking for if they, audit you?
Right, that's the crucial starting point. Think of it as 3 pillars of eligibility. You absolutely have to clear these. First pillar, the exclusive use test.
Exclusive use.
Okay, means exactly what it sounds like. The space you designate for business. It has to be used only for your business, period. Any real personal use, like having a guest bed in there or letting kids' toys pile up, that can kill the deduction for that space.
Wow, okay. No overlap allowed.
Pretty much. Now, it can be a clearly defined part of a room, maybe separated by furniture, as long as that specific spot is only for business.
So a desk in the corner of the living room could work if it's only for work and nothing else happens there.
Potentially, yes, if it's clearly delineated and exclusively used. But it's tough.
Strict. Okay, what's pillar number 2?
Pillar 2 is regular use. It's not enough to just, use the space occasionally. It needs to be used on a continuous, ongoing basis, integral to your business.
How regular is regular? Do they give you like an hour count?
No, they don't give a specific number of hours, which can be tricky. Consistency is the key word. You need proof. A work log, maybe a calendar showing you're consistently using that space for business activities. That's vital.
Got it. Consistent, regular use. And the third pillar?
Third is the principal place of business test. Now, this one trips people up sometimes, especially if they say, visit clients outside the home.
Right, like a consultant.
Exactly. But there's a really helpful provision here. It's often called the Administrative and Management Safe Harbor. Basically, your home office qualifies if you use it exclusively and regularly, specifically for administrative or management tasks. Things like billing, keeping records, scheduling appointments.
Oh, okay.
And this is the important part. You have no other fixed location where you do those substantial admin activities.
So even if I do my main work, say coding, at a client site, if I manage my invoices, scheduling, all that back-end stuff, only for my home office.
Then your home office likely qualifies as your principal place of business under that safe harbor. It's huge for many freelancers and contractors.
Okay, those 3 pillars make sense. Exclusive use, regular use, principal place of business. If you clear those, then you calculate.
Then you get to choose your method. There are 2. The actual expense method and the simplified method.
And this is where strategy comes in, especially for homeowners, right? You mentioned something, depreciation.
Yes, depreciation recapture. This is fascinating and really impacts the long term. See, if you use the actual expense method, you calculate the business percentage of your home and deduct actual costs, mortgage interest, utilities, repairs, and depreciation on the business portion of your home.
Okay, sounds like it could be a bigger deduction.
It often is, but you must claim that depreciation each year. And here's the catch. When you eventually sell your home, all the depreciation you claimed, or even just could have claimed, allowed or allowable, the IRS calls it, gets recaptured.
Recaptured.
When you have to pay tax on it, often at a special, potentially higher rate, sometimes up to 25%. It's like a deferred tax bill suddenly coming due.
Wow. So the bigger deduction now could mean a surprise tax hit later. That really changes the calculation, doesn't it?
It absolutely does. Which brings us to the alternative, the simplified method.
Simpler sounds good. How does that work?
It's very straightforward. $5 per square foot of your home office space, up to a maximum of 300 square feet.
So a maximum deduction of $1,500 per year, 5 by $300 per year.
Correct. It's capped at $1,500.
Yeah.
Much simpler calculation, less record keeping for expenses. And here's the big advantage regarding that recapture issue. With the simplified method, you don't claim depreciation. So there's no depreciation recapture when you sell your home. You avoid that future tax liability completely.
Okay, so trade-offs. Actual method, Potentially bigger deduction now, detailed records, but future recapture tax. Simplified method. Smaller deduction cap, simpler records, no future recapture tax.
Exactly. But there's one more wrinkle with the actual method.
Wow.
If your business has low profits or even a loss in a given year, and your home office deduction calculated using the actual method is more than your business income, you can carry forward the unused portion of that deduction to future years when you do have profits.
You can't do that with the simplified method.
No. With the simplified method, if the deduction is limited by your business income, any unused amount is just lost, gone forever for that year.
So flexibility matters too. Can you switch between methods?
Yes, you can switch year to year. So you might use simplified for a few years, then switch to actual if it makes sense. Maybe if you have large home repairs benefiting the office space, or if you anticipate carrying forward a loss, it allows for some tax planning.
This all sounds like something the IRS might look at closely. You mentioned audits earlier. The burden of proof is on the taxpayer, right?
Yeah, absolutely. Entirely on you. This deduction has historically attracted scrutiny, so documentation isn't just important, it's everything.
What does audit proofing look like in practice?
Think of an audit as the IRS saying, "Show me." You need a rock-solid substantiation file ready to go. Key things: dated photos or even a video walkthrough of your exclusive business space. Prove it's not also a playroom.
Okay, visual proof.
A detailed floor plan with measurements showing the total square footage of your home and the square footage of your dedicated office space. Calculate that percentage precisely. And that contemporaneous work activity log we mentioned for the regular use test, showing when you work there.
Makes sense.
Yeah.
What are the big red flags that might trigger that show me request from the IRS?
Well, failing that exclusive use test is probably number one. If an auditor sees a photo with a Peloton bike and a guest bed crammed in your office,
Yeah, that's not good.
not good at all. Also, claiming an unusually large percentage of your home as business space can raise eyebrows. Or showing a significant business loss year after year while also claiming a large home office deduction. They might question if it's truly a business or more of a hobby with expenses written off. Consistency and reasonableness are key.
So wrapping this up, the home office deduction. It really is a powerful tool, isn't it? Turning personal costs like rent or mortgage interest into business expenses.
It is uniquely valuable for the self-employed. It directly cuts down not just your income tax, but potentially your self-employment tax, too. That's a double benefit.
But it comes with strings attached. Very specific strings.
Extremely specific. Your confidence in claiming it really has to rest on those three pillars we discussed. 1, unwavering adherence to the rules, especially that exclusive use test. Be honest with yourself about how the space is actually used. 2, a strategic choice of method. Actual versus simplified, really thinking through those long-term things like depreciation recapture. And 3, meticulous proactive documentation. Don't wait until you get an audit notice to pull it together.
So it's less of a simple write-off and more like a strategic financial decision you need to manage carefully.
Precisely. It should be part of your overall business financial planning.
Which really leads to a final thought for you listening.
How will understanding these nuances, the strict rules, the long-term tax implications, the need for proof, how will that change how you approach your business finances and record keeping this year?